Okay, let's call a meeting to order. Right. You need to take a roll.
Yes. Okay, member Sleet, he's passing. Vice Chair Skolnick,
Here.
Chair Hill,
Here.
member Jane,
Here.
member Brickley,
Here.
and then Mayor Owen, here should be. Always be on late, and Vice Mayor DeGoya will be in around 3.
Are there any public comments? Anyone online?
No, no one online.
Let's go to the regular agenda items then. First is review, include the draft minutes. Here the packet, this is November 18th meeting. Any corrections or comments on the minutes?
I mean, there was a typo in section 2. Part of that reduce property tax. Absolutely. Minor nit.
Anything else? Do I have a motion to approve the minutes with the one change?
I'm motion to approve the minutes, no changes.
All in favor? Okay.
Then he'd sit next to Andrew, sorry. Moment. So
So next item is review of the PARS OPEB trust. Quarter ending September 30.
did we do a motion? The motion, I'm sorry, I missed it. The motion for the minutes?
Yes.
Okay.
Oh,
Okay.
the introduce us. Yes.
Yes. Thank you. Yes, so before us, we have presentation just real quick on this item 3 is a review to discuss a PARS OPEB trust program and a snapshot of the quarter ending September 30th, 25. Review presentation by PARS administration in our PFM asset management group, investment of funds. We'll discuss the quarter and then, thank you. Flow of funding and to the trust, and we'll discuss the expense and investment discussion. So with this item real quick, I just want to give a background in the staff report. At our September 9th Finance Committee meeting, the committee reviewed our roll forward OPEB valuation and liabilities and assets as of June 30th, 25. We provided the latest OPEB actuarial report and the balance of the PAR trust as of 6/30/25. In the staff report, it was showed a decrease in the OPEB liability of 171,000 and to 7.9 million against an increase in the town fiduciary net position of 9,057,000. This is an increase of 388,745 in net position. They revealed our net OPEB asset balance of 1,070,000. So today's meeting, we're providing an update to the annual program for the PARS Trust as of November 30th, 25, and then we're going to do an overview of the investment performance for the first quarter ending September 30th, 95. So in the staff report on page 2, I had listed the roll forward that we reviewed at September 9th at our September meeting, and then the 6/30/25 trust position updated as of 11/30/24. So there was the trust balance went up to 9.25 million. To the OPEB liability 7.98 million, and net OPEB asset increased about 170,000 to 1,268,000. So there's still a favorable asset in experience that contributes to the decrease in our net OPEB liability. And again, we have our presentation here. We have Director Andrew Brown of PFM Asset Management to present today. And also we have Administrative Director, Jennifer Mesa with PARS to discuss the outlook of the pre-funding trust program. And I see that what was just handed to you is the actual hard copy of the presentation that was included in your packet. So without further ado, I would like to turn it over to Jennifer Mesa of PARS and Andrew Brown of PFM Management. And I will pull up the presentation online so you'll be able to see it as well as they talk through it. So without further ado.
All right, perfect. Thank you so much. And good evening or good afternoon, everyone. Thank you for having us here today. I went ahead and put together a presentation here for you. We won't cover every single page, but we wanted to provide you as much information as we can in case you have additional questions that we can reference to. If we go to slide number 2, just our contact information at any point in time, feel free to reach out to us if you have questions. If you don't have any today, but maybe in a couple days or after this meeting, something comes up, we're always available to assist you. Slide number 3, just a little bit of a reminder of the trust team. Myself, I'm from PARS, Public Agency Retirement Services. We do the administration of this account. So the record keeping, the audits, the reporting, all of that is done by PARS. U.S. Bank holds the over $9 million that you currently have and safeguards those assets, and oversees PFM, where Andrew is from, making sure that everything that the town has requested for the investments is being properly done and managed through PFM. So those are the different parties within the group. If you have any additional questions, I can answer them. Slide number 4, we go through the program. You have what's called a combination trust that allows you to put money aside for retiree healthcare obligations. And you also could technically put money aside for pension. That's something that we talked about maybe a little bit over 5 years ago now. That part of the bucket has now, or that part of the program has not been utilized, but you have flexibility. Currently, you're only using the OPEB side. As I mentioned, you have over $9 million in that. You select when to put money in, and you have flexibility of taking that money out. You can take that money out to pay for any retiree related expense, whether you reimburse the town back for those expenses. If you have some kind of stipend that you provide them, we can pay them directly. We can pay a third-party provider that may be offering some of those benefits out of the trust. And for any actual evaluations, you can pay it out of the trust as well. So a lot of different ways that you can utilize the asset. Slide number 5. Top portion just shows you this program started back in May 16th of 2012. Town manager or city manager is currently the plan administrator. So on behalf of your city council and this committee, any changes would be done there by Georgia Still. The investment strategy is called the moderate index strategy, which Andrew's going to go ahead and talk about in just a couple of slides. That is not something that is locked in. The city can, or the town can make changes at any point in time to that investment strategy. And that's why we try to meet on a regular basis in case things happen or something else changes with the town and you want to make changes to the investment. So that can be done at any time of the year, at any time that we meet. Bottom portion are your assets as of November 30th. You've contributed a total of $9.4 million into the account. That includes the initial June 2013 contribution of $1.2 million, plus the additional $8 million in there. You have taken money out. You've been taking money out almost every fiscal year, a total of over $5 million taken out of the trust. Your net investment earnings from PFM have been of over $4.8 million on there. And the account balance, as I mentioned, November 30th is $9.2 million in the account. Line number 6 shows you this information based on the historical information on every fiscal year that we've been in the program. So you can see when the money came in, you can see your total assets there. And then of course, those reimbursements taken out of the trust there in the center column for you. And you can see since 2024, we have not had any additional contributions into the program. As you'll see in the next page, the plan is very well established. In a very healthy place. The town has done a great job of establishing the program, putting money aside, and really addressing those liabilities on the account. So all we are seeing in the last couple of years is reimbursements to pay down those retiree healthcare obligations. Slide number 7, this is the liability for this specific program. These reports are not done by PARS. You currently use a company called Precision Actuaries that does that for you. And what we went ahead and did is compare the 2024 versus the latest 2025 on there. The discount rate or the long-term expected rate of return for this type of plan under this portfolio is about 6.5%. So that's what the actuary is quoting on there. That gives you a total OPEB liability, or what currently is due for this type of liability with your town, of about 7.9 million. Now, the actual money that you have in the trust is over that at $9 million. So as you can see, currently, if you had to pay the bill today, you currently have assets to meet all of those obligations. Now, again, that's a running number. It can change. That's why you do actuarial evaluations at a minimum every 2 years, because things can change, premiums and so forth, costs can change. So that is a floating number that we'll see from time to time. At this time, you're in a very healthy funded status. You're funded at 113%. About less than 5% of our agencies in California are that well funded. So good job to you, to the town and staff for actually establishing this, funding it, and having it in such a healthy condition. And then the last number that I want to take a look at there is the annual benefit payment. The about $500,000 that you currently pay out for these type of liabilities. You can always take that out, which you're currently doing to out of the fund.
Oh, sure. I remember this one from last year.
Slide number 8. I'll have Andrew touch base more, as I mentioned, on the investments. This is just historically what you have returned with the inception to date of 6.47. In the previous slide, I had mentioned your discount rate is 6.5. So you're right there meeting that discount rate from the actuary as well. That's what I'll point out there. And then I'll have Andrew come back if he needs to that slide. So that is the administrative portion of this program, details on your assets and so forth and your liability. I'm going to turn it over to Andrew to discuss the investments, but are there any questions on the slides that I've touched on already? Okay.
Robert, I think there was some pre-meeting questions, one of which I think was fairly much in Jennifer's role. Do we want to do all questions at the end, or do you want to?
I think one of them was the reimbursement.
You mean the flow of funds? Yeah, we can handle that right now. In my staff report, I never discussed it. Correct. So PARS administers the retiree health benefit for us. So every month, through our retirees have to participate with CalPERS Health. And so because we have this trust with PARS, we get the bill every month from CalPERS, and then we verify based off of the individual retiree, whatever plan reimbursement they get, we take that, we reconcile it against what their premium is, and then we reimburse them their retiree health. Because CalPERS, what CalPERS does is they deduct their retiree health out of their pension. So that comes out from CalPERS. They take out the retiree medical from the retiree, the annuitant. And what we do through PARS is we reimburse the retirees their medical. And so every month we send that to PARS, a list of all the individuals. They already have their address, they have their bank information. We set it up and we send every month prior to the end of the month, before the annuitant's healthcare is taken out. We send that list to PARS, and then PARS reimburse each individual annuitant their reimbursement amount, health reimbursement amount. And so on that slide, that took previous slide on page 6, we saw the disbursements. So the disbursements amount you can see are all in that column under the disbursements. So as of June 26th, and again, this is on a calendar year, as of June 26th, we contributed $347,000, and that's what was contributed in total to reimburse the annuitants their health, retiree health care. So PARS, we work in tandem with PARS on this, and you could see it as a fiscal year 24. We stopped doing contributions because what we were doing prior, the town would, every month, the town would contribute whatever that retiree health for the month was. So if it was 35,000, we were contributing 35,000 to PARS, and PARS was taking that amount and dispersing it to the individual retirees. So that's how the flow of funds works, and that's how we use the retiree trust. We use the trust because it's in doing so, the retiree is not taxed on that benefit because we're reimbursing through the trust. So with the Jennifer had mentioned that we do the OPEB actuarial report, that's Precision Actuarial that does their actuarial report. We work in tandem, we send that to PARS, and that way we can kind of gauge and see where we're at based off of our assets and our liabilities. And so PARS helps us with that, administering that, reviewing it, and then Andrew is on the investment side, making sure that we meet the investments for it. And also the cost, the expenses for the administrator and the investment also comes out of the PARS trust. And I'll touch base on that after we talk about the investments. But that's all I have. Is there any questions? I just wanted, that's how the process works with PARS. And then they manage they administer the plan for us. Any questions? So then I'll turn it over to Andrew.
Let me have you go, Robert, if I could, to 2.8, page number in the bottom right-hand corner.
There you go.
Yep. So it's good to be back here. Thank you for the invitation. As the finance director Barron highlighted in the staff report, I'm going to touch on performance. We'll take a look at the economic snapshot of PF and asset management, highlight positioning for the portfolio. And then I think there's also some supplementary questions were submitted related to fees and expenses and investment policy statement. So those are going to be the 5 topics, but any other topic that you want to discuss, just feel free. So this is my first investment presentation for calendar year 2026. And so the slide that we're looking at here, the quarterly market summary, the factors to consider over the next 6 to 12 months, this is something we call our heat map. And what we do is we take 9 economic and market variables and we apply some type of color-coded rating system to our outlook on these 9 dynamics. And it's designed to cover a 6 to 12 month horizon. The color coding corresponds to red and yellow, some type of negative view. Gray there in the middle would be a neutral outlook. And then light green, dark green is some type of positive view towards one of these dynamics. Upper right-hand corner, you'll see it's ending September 30th, 2025. So we have not updated it officially for dissemination for the 12/31 period of time. But I have people who have shared our views, and they haven't changed. So where you see the black dots on these 9 dynamics are exactly where we are today, and certainly we can debate. Maybe we should have moved something here and there. When I think about the 6 to 12 month horizon, predicting the future is difficult at any time. I think we have a better handle on a 6 month horizon versus a 12 month horizon. And if we were thinking about the next 6 months, I think we're pretty constructive, pretty positive. I think growth in the United States is going to be pretty solid. And a lot of that positive feeling really comes from, where we have many of these black dots in the green regions, upper left-hand corner. First off, monetary policy. We're still working through the positive impact of 2024 rate cuts. We got some rate cuts in the 4th quarter of 2025. And then our best guess is we get 1 or 2 more here in 2026. So that was maybe some of the catalyst to putting that rating as a positive outlook for monetary policy. Interest rates, in our view, are likely to continue to trend downward. Financial conditions look excellent. Much of that really stems from the one big beautiful bill that was signed into law there on July 4th that has some tremendous provisions for corporations to expense R&D and CapEx, as well as it is widely anticipated that tax refund season in the upcoming quarter, or later this quarter, second quarter of this year, is going to see some pretty significant tax refunds for individual tax filers. And typically when you get a windfall of cash coming in, Americans typically spend it. So we think financial conditions are poised. And really, I mean, if it was just a 6-month horizon there at 12 o'clock, we'd probably move economic growth to one of the shades of green there. And we also probably would move consumer spending to one of the shades of green there right in the middle. With respect to inflation, the upper right-hand corner, we do have it rated as a yellow. We did get CPI today. CPI headline was 2.7, core was 2.6. Still kind of closer to the 3% level versus the 2% level that the Fed is looking to target. Many economists out there point to 2%, kind of maybe a little bit hesitant to put my initials next to that. It might stay at the mid 2% level, but maybe not so onerous from a policy standpoint for monetary policy, halting the Fed from cutting rates going forward. Labor markets, we do have it rated as a yellow there at 3 o'clock. And last 5-6 months, we've seen a slowdown in job creation. It's been sort of what's been termed in the media, and I hate reusing beaten into the ground phrases, but I will today. Low hire, low fire. There's not a lot of terminations out there, but there's not a lot of new job creation either. Some economists point to, well, with the slowdown in immigration, maybe we only need something along the lines of 50 to 60,000 new jobs. The Dallas Fed put out a report in the fourth quarter, putting forth that potential data point that maybe 50 to 60,000 new jobs might be that neutral rate of growth. Maybe not, but certainly with the low number of new jobs that have been posted in the economy, we feel pretty comfortable still keeping it at yellow in terms of our rating. And then just two other quickly items that I'll touch on. Valuations. Some argument, some pushback there at 6 o'clock. We have it at slightly negative. Sometimes clients will say, well, why don't you put it at red? And maybe because of the textbooks that I at least studied growing up, it kind of feels a little bit expensive or very expensive there at 23 times price to earnings ratio for large cap stocks in the United States, the S&P 500. So my inclination is to be a little more conservative. My other colleagues feel that yellow is maybe the one that deserves the merit. But the market's a bit overvalued, to say the least. And that's worrisome, because if we don't get the economic growth in the corporate earnings that we anticipate in 2026, we're probably poised for a market sell-off. And then we get to the fun part of the presentation where we talk about policy and political risks. That always seems to be a hot topic with committees and whatnot. 3 months ago, well, I guess I didn't totally lay out the presentation format. When you see a white dot is where we were maybe 3 months ago. So if this is for the 9/30 ending period, for that June 30th to end of September period, we had it at excessive risks. We moved it to yellow. And I know what my colleagues were thinking about when they moved it from red, highly negative, to slightly negative. It was sort of the notion of, and it wasn't a debate of whether or not the Trump policies were disruptive. Yeah, they are disruptive. But it was maybe the recognition that the market really wasn't caring too much about the disruptions. And maybe also not all disruptions yield negative outcomes. And so when we think about some of the policies that have been enacted over President Trump's first 12, 13 months in office, there's been some highly disruptive policies, but with okay outcomes. One would certainly be the One Big Beautiful Bill that's going to be a huge catalyst for the economy. And it's already been a very nice catalyst in some industries. Operation Midnight Hammer, that was certainly a positive. And then also some benefits coming from the initial deregulation policies enacted. So yeah, there have been some positives. But then you just kind of go through the first 11, 12 days of 2026, and it's one to make my head spin. And I just kind of jotted a few down. Venezuela, abduction of Maduro and his wife. Trump cajoling oil executives to invest $100 billion in Venezuela, a country where many of them got kicked out several years ago. So, how, eager are people to, once burned, twice shy sort of thing. Strong overtures to invade Greenland, directing Fannie Mae and Freddie Mac to purchase $200 billion in agency mortgage-backed bonds. Truth Social posting calling for prohibition of institutional investors to buy residential homes, preventing defense companies from buying back stock and issuing dividends. And then just yesterday, trying to cap swipe fees for credit card issuers at 10%. I mean, it's a lot. It's a lot for one administration in 1 year, not to mention 12, 13 days. So I don't know if you want to push back in terms of, hey, why don't you guys put it back to red? I certainly wouldn't. I wouldn't fight you. But yeah, I don't know if maybe, hopefully it's nothing more than a debate about, just the merits of, where do you guys put it, red or yellow, rather than, hey, you highlighted some of the good benefits of constructive policies. Hopefully these current policies don't yield negative results for the remaining 3 years of his presidential term. So, yeah, that wasn't much of an overview. It was maybe a little bit longer than I anticipated, but this is my first time in 2026, so I'll get better.
Fine.
Any questions or feedback on any of that? No? Okay. All right, Robert, maybe page 2.9, which I think is the next one. And just a quick stop on this page. This covers our asset allocation positioning. And the one sort of scarlet letter for us in 2025, calendar year 2025, was we moved a slight underweight position to equities there, called maybe the third week in April. We got a little bit nervous about the potential negative input of or impact of tariffs from Liberation Day there on April 2nd or 3rd. And we moved from a 50% equity allocation to a 48% allocation in this portfolio. So it was a slight underweight. It wasn't a big move. And like I said, the market didn't really seem to care. It kept on going up. And so maybe the third week in July, we moved back to a neutral allocation, going back from 48% to 50% in equities. And we've maintained that position across all of the asset allocation decisions within the plan. So when you look at this and you look at all the black dots in the neutral section there in the middle of the page, US equities, international equities, combining that together, that's going to be 50% of the portfolio. Fixed income is going to be 48%, and cash is going to be at a 2% allocation. And that's where we've been since the third week in July. And that's where we maintain our current position today. Robert, maybe page 3.1. And so this is going to be, and I think Robert, you put the first quarter. It is the first quarter of the fiscal year.
Fiscal year, correct.
Third quarter,
Of the
at least how
calendar year.
we're mapping it on here.
Correct.
And so, maybe the most relevant column to look at, and I'll be happy to look at any column here, would be maybe the 1 year column there, third or fourth one over from the left. And for the first line item, total portfolio, this represents the total portfolio for the pool that we're invested in. You saw a page that Jennifer presented, her last page in her presentation. That actually took a look at the cash flows for the town's portfolio. And that actually would be maybe a more relevant period or relevant exhibit to look at. And maybe we can kind of finish off on that if you want to. So in terms of a 12-month period of time, the actuary says make 6.5%, and we generated a 9.92. Does it show 9.65 up there?
Yeah, 9 point. It says 9.65, but the
book shows 9.9.
9.92.
Oh, yeah, the hard copy is not gonna pinch.
No. Yeah. Well, we're gonna go with
I'm sorry.
9.92 because that's the book.
But the one in the book, in the packet, is 9.92.
Yeah.
That's correct.
So we're gonna go with 9.92. Apologies there. And so, yeah, way ahead of 6.5% for a 12-month period of time. how did we get there? Well, we certainly got there on the back of the equity market. The domestic equity line item there, 17.2%. The international equity line item, 17.3%. When we do our capital market assumptions, we expect domestic equities to get about 7% and international to get about 7.4%. So, heck, that's almost 2.5x of what we would expect to generate over a 12-month period of time. So that's certainly indicative of a really good 12 months. Other growth is a category where we lump in together some diversifying assets, real estate, as well as infrastructure. Thumbs up on the infrastructure investment at 16.2%. That was one of our best performing asset classes over the last over that 12-month period of time. Real estate struggled. Real estate struggled over this period of time. I think investors were kind of hoping they would get a little bit more in the way of interest rate cuts to maybe spur that real estate market. It was actually the only category that has a minus sign in front of it over this 12-month period of time at 2.3%. Fixed income was at 3.3%. It's a better story when you look at the 9-month period of time for this portfolio at 6.2%. And then when you throw on about 1% there in the fourth quarter, we got about 7% from our real estate investments, which it's important because in a 50-50 portfolio, half of it does come from real estate. And real estate has been one of maybe the more disappointing areas for the portfolio, for the plan. And it's not really any of our doing because we're invested in an index fund, if you will, for fixed income. It's the more so the market and the low interest rate environment, and also 2022 when the Fed increased interest rates up at a very high clip. But over that 12-month period of time, 3.3% return. And then finally rounding it out, cash. While the Fed is cutting rates and that is impacting some of our money market yields, we were able to still generate about a 4.5% return on our cash. We don't have a lot in cash. As I said, it's about a 2% allocation. But it wasn't detracting over that period of time. So putting it all together, just a shade under 10%. Very happy to show that to you. I will give you the estimate based on, we don't have our final numbers solidified just yet. But it looks like we had about a 1.8, 1.9%. We'll call it the second quarter of the fiscal year, fourth quarter of the calendar year. So maybe just a shade under 2%. So not about 3 months to end the calendar year. I said I was going to talk about positioning, and maybe that slide that we looked at previously does capture that at a 50-50 allocation. That is currently where we are at.
Andrew,
Yes, sir.
just to go back to what you said at the beginning, the total portfolio and then these other things, you said isn't necessarily Atherton's portfolio.
This would be the investment portfolio that the town of Atherton, and I'll make up a number, 6 to 7 other agencies are invested in.
Okay.
So your portfolio assets, your plan assets are in this portfolio, but it's not totally isolated to the town.
But so the town's returns would be exactly the same then?
It would be maybe a little bit more or maybe a little bit less than what the other plan or whether the portfolio participants are experiencing. The drivers of that would be cash flows going in and out. The drivers also would be fees and expenses, which we're going to touch on probably about 90 seconds. I think you're maybe one of the more larger participants. And so it's a gradated fee schedule. So the more assets you have, the lower fees and expense that you incur.
The assets are segmented, so the buckets, the pools are each town, right? So their inflows and outflows are going to affect something. So when you're invested in bucket A, you're going to put more in the equity. You're going to reallocate in that portfolio. Maybe bucket B doesn't have the cash available to do it, or it's just timing issues and all this stuff.
It's not.
It's all of us have the same amount of money, but one person needs a little bit more and one person is getting a little more.
It's not segregated. So that's the key point.
It's not. It's a pool.
It's a pool. So let's say, for example, Salinas. I'm making this up.
Yeah.
Salinas is in this pool. Salinas needs a $7 million distribution to pay plan participants.
Yeah,
They will say, portfolio manager, make sure that we have enough liquidity. Portfolio manager checks, yes, we have $12 million in liquidity. US Bank, as plan administrator, would hold these $7 million.
that 12 is if we're all each a town, that's all of that's everybody's 1.5 or so.
Some, but then upon, at a certain point in time, the investment manager says, oh, well, geez, we are low in cash, or we've moved from our
Yeah.
target asset allocation position.
Yeah,
And then we have a decision to potentially rebalance that portfolio.
sure. So if it's pooled, why would, I imagine these returns are really close, but why would it matter per city then? If we all have a big thing all together, then we're all getting the same return. If you want $7 million, it's coming out of that big pool.
I would offer, well, if you consistently put more money in, well, let's say you were the only agency
Right.
that was putting money in the
Right.
pool. I don't believe that if you were putting money into an individual account, I don't think that the cash flows would, the performance based on the cash flows would exactly foot to the performance based on.
Right. Maybe the thing that we care about is that we don't suffer as a result of other people's cash needs.
Certainly appreciate it. I don't think that you do. But there is a dynamic there.
Mhm. Especially when we're overfunded. So if we're overfunded, we could sit back and have Robert's cash needs met without too much trouble. So
And
maybe it's a
Robert's
question,
cash needs
maybe
is
it's,
actually one
maybe it's a
of the bigger.
question for next time for you, if we want to get into the weeds. I don't want to get too far into the weeds because I think you miss things. But maybe is the mechanism and is the way that you operate and the policy of the way that you operate it such that that towns that are overfunded, so to speak, are actually benefiting from the overfunding, so as to we're helping the underfunded.
We're
Oh,
actually
no.
the biggest draw. you're starting to say, right?
Well, definitely two different dynamics
Yeah.
going on here. I mean, your funding policy, to me, I begin to think, okay, well, if you're 113% funded, which I think if you mark to market through November, then we begin to think about, well, do we need to take 6.5, the risk commensurate with the 6.5% discount rate, which in our recommendation is a 50% equity, 50% portfolio. So that's completely germane to the town. It doesn't really impact or consider other agencies within this pool. And our answer would be, yes, we would recommend maintaining the course with a 50-50 portfolio because of the cash requirements. I mean, because right now, what did you disperse last year, or the town disperse? 4.5-ish,
Yeah.
almost 5%. So if you think about the dynamics here, you're assuming 6.5%, but you're also kind of distributing 4.5. Couple nickels for our fees and expenses. You have a little bit left in a perfect world, right? And this isn't even factoring in those years where we have down mark. You have a little bit left over for compound growth, but we're really not in growth mode. I mean, we're using the assets for what they're intended for, to support the liability.
That's maybe even more, I'm just trying to get the basic question as I can.
Yeah.
How are we affected by other towns? We could isolate our assets and stick them right here in our corner and have everybody else stay over there. Do we do better or do we do worse? Or we just do the same? Does the pooling allow you to do the administration that you need and pull this whole thing off at less of a cost? That's why we pool, or
Well, there are three questions there. I had a no, that had a yes, and the, one thing that we typically do is and this is, well, the we is the royal we, but it's really the trustee. The trustee establishes a limit, usually at $10 million, to have an individual account. And the town since day one has been under that limit. 92, 93. I mean, potentially we could talk to the trustee Since my paycheck has the same name that the trustees has, I mean, we could potentially look at an individual account. Key point though, we would not do anything different than what you see on the asset. You see the percent sign with the allocation there? We would allocate it the same way we would manage it the same
I
way.
know, as soon
But
as,
you wouldn't be potentially positively or negative, you wouldn't be impacted by other agencies' cash flows in or cash flows out.
cause it got affected.
Yeah,
A smidge, but it could be to the positive.
It could be.
But
The point is, we don't know, so you just sit there. and
I'll
you don't
answer it
know.
in maybe a slightly different way. When we put together our portfolio composites, our investment composites, so when we show the world, you know, quote unquote, how much better we are than the CalPERS, right? We're going to an RFP. And we put together our composites for the 50-50 portfolio. The variance in terms of our returns for our 50-50 portfolios, it's not too wide. So when I see that, it's not too varied. So when I see that, I say, well, whatever the cash flows in and out of those 10, 12, 15 accounts that make up our 50-50 portfolio, it's not really walloping one or pool, and it's pretty tight. But if, as a homework assignment, you want us to look into maybe doing a separate account,
if you
we
would,
can look
if
at
you
it.
would just confirm why there would be, if you would like look into why there's a difference.
It's cash flows, but I'll give it, I'll
Yeah,
write out an
To me, it
official
would
answer.
be, the thing that would make sense would be that each pool participant, their return depends on the timing of their inflows and outflows. At the portfolio level, it's like an average of that, but we shouldn't be impacted by what anyone else is doing.
I'd
Shouldn't
isolate
be
it
from
if
a
it were me.
philosophical standpoint, or shouldn't be from an investment,
Well, both.
well,
I mean, you should have a system that doesn't impact us, depending on what other people are doing.
well, so then I would encourage you to.
Just see if you can isolate it. That's what I would do.
I would encourage you then to discuss it if you do want to pursue an individual account.
Well, the first thing would be if you could maybe get back to Robert and explain exactly how differences can arise.
Sure, I'll give an official one pager.
I gotta think it's gonna be really hard to isolate that.
When you say isolated, I can't do the
Yeah,
accounting.
what if? Yeah, that's.
Yeah,
gonna be
no,
impossible.
that, I'm gonna give it a philosophical,
Yeah, yeah.
these are the three reasons why you would anticipate a different return between an individual account where it's just your $450,000 coming in and whatever contribution you're putting in versus the experience of a commingled pool that has, you know, a very, I mean, the main thing, Thomas, is okay, well, we ended the quarter there at 2.6% cash. Other pools might have ended the quarter at 1 point something% cash, or maybe 5%. Maybe somebody got a 10% contribution to cash that we were gradually dollar cost averaging in, and we dollar cost averaged in on great days, which slightly increased. You know, we bought low, and then it went up after we put that large contribution in, and it gradually showed a little bit of upside in that pool experience. I mean, and like I said, I'll give you the memo, but that's the main thing
I
after
take a
20
look
years.
at isolating it. It's as if Tom and I got together and said, hey, let's combine our retirement accounts together. And we'll have an accountant that kind of figure things out, we'll allocate it out. You might need some money and then I might need some money.
Yeah.
After, you
Your
know,
R&D is this
I
and
told
his
him, I don't
R&D
want him
is-
to have my retirement account, he doesn't want mine either.
Yeah.
So is it, do you think a similar expense ratio for operating on a separate account versus a pool?
We don't charge anything more for an individual account. So that's you're charged based on your assets under management. Since that's one of our check boxes, let's knock that out right now. Let me see. What did I put?
So if we wanted it separate, it wouldn't cost us anything. Is that correct?
It doesn't cost me more. Yeah. The blended, the expenses for the index funds, the weighted average for the index funds is gonna be 4.8 basis points. And then I think I calculated the expense for 9.2 million at 30.7 or so. So I think we were just a shade under 36 basis points all in for investment management. So it's the embedded expenses for the index funds and what PFM Asset Management US Bank charges.
What's the review process for that? One of the things I mentioned last time was Fidelity's got a 0% total market index, I think. Is there, is there a process that has to substitute lesser cost? Can we go from a third, from 0.3 to 0.25? Is that something that's looked at?
I respect your diligence in terms of trying to get the lowest cost. I mean, one of the things that we do think about, I mean, obviously we think, especially with index funds, we think about fees and expenses.
Because it's easy, because you guys can keep your management, keep the fees related to it, and run it the way you're running
We
it,
need,
and drive the cost of the portfolio down.
we need liquidity, and we also need a provider that won't tag you for because sometimes if you pull money out within a 30-day window of time, they'll assess a modest penalty.
Yeah.
No,
I'm not wondering about, I'm wondering about what the process is for not just us, but for the others, where you look down when was the last time you had a fund change? What's the process for looking down there and going, I have Fidelity Total Market Index, there's other total market indexes that are out there, and they may track the index similarly, the same, and they may be at less cost. Do you have a process where you go, it's January, it's time for us to take a look at that?
well, it actually kind of follows that sort of rubric for index funds. I mean, it's probably going to be a once a year dynamic. I mean, it's not going to be a
But
quarterly
still, I
dynamic,
mean,
but-
we just, that's how you got to
Yeah,
0.30.
so our manager research group would look at index funds pretty much on an annual basis. Determine liquidity, determine if there's any fund provisions that change.
Mhm.
Index funds typically don't raise their fees, so.
What about substitution? Does that happen often? Does this
It
Fidelity?
doesn't
one kind of
happen
live forever?
often, and when it does happen for index funds, it's, this fund is not really tracking the underlying benchmark. Why is that?
Yeah.
Well, this international fund doesn't have exposure to Canada. Well, who
Yeah.
cares? It's only 6% of it. Well, wait a minute, we care because we're not tracking it. So that's usually more of a catalyst to make us think about a replacement for an index fund.
Yeah.
Well,
Because our plan here is to have, I just got the statements, is to have all these funds, show what they are, look at what their tracking record is, look at what their expenses are, and see if there's a substitute for it. And then just ask, go, hey, there's a substitute for Fidelity of whatever. Are you guys considering that? If we have our own pool, does it make any different? Or is this a policy decision that you make for everybody? Everybody's going to get the Fidelity fund.
it's a policy decision that everybody gets. Yeah, so.
That's a good one, though. I think if you track the same and you have less expenses, why not do it?
Well, sure, I mean, all things being equal, but all things aren't always equal, and you do have the tracking error with the underlying index. And
Agree.
liquidity is a big deal.
Totally agree.
And there's also some providers that will, nickel and dime you in terms, and remember, I mean, we have a lot of inflows and outflows.
Okay,
so,
I get it.
The fund provider thinks that we're buying and selling and flipping things around, and we're not.
Right.
But yet they still want to give you a little bit of a
Right.
penalty, and that's BS.
Fair, that's fair.
Yeah, so just to piggyback on that, on the investment cost. So the costs are about, as Andrea mentioned, about 30 basis point. So it's about 26,000, and then with the administration, it's about 24. So the total
It's unbelievably
expenses is
low.
about 49,000
Yeah.
on the
$9
8.8 million is the cost between the administrator and the investment. So about, we're looking at 48,000 cost per year, about 8.8 million. That's it.
Is part of this discussion going to be on short allocation, on our equity versus bond, or
But yeah, we'll bring that back, when we do our end of the year, we'll review, we'll say, this is, our investment strategies is the model
Right.
index, passive. Do we want to change it? Do we want to, be more conservative?
So that was the last one we just did?
Yes, that was the one in June. Correct, and the committee recommended we just stay where we're at, because that one meets the, at the time, it was 6%. Our investment return, but through the actuary, I mentioned that now it's 6.5%. So, and the plan is, the investment plan is making, is
What's the
close to
next
that
step up?
6.5.
Is the next step up from ours is?
Balanced. Balanced is something we run, the target allocation would be 60-40, 60% equities,
Yeah.
40% bonds.
Okay.
The range is 50 to 70% equity, so it can go as low as 50.
Mm,
If you think that that's low, I mean, that's our target, and then as high as 70.
mm.
I didn't come, and I did my own internal pregame prep. I didn't come here thinking, I'm gonna talk an overfunded plan to
Yeah.
take more equity risk.
It seemed counterintuitive, I know.
Yeah, we'll definitely bring that back. We always
Okay.
review the investment strategy to see where we ended up at the end of the year. But we're bringing this because we wanted to start reviewing it as a quarterly snapshot.
Yep.
Rather than the yearly that we're doing. So this is just the quarter review. So we're about 200,000 more in the net position than we were in June of 25. So we made 200 something thousand, even though we've been distributing money out of it. So the first quarter we're in a positive 200. So if we do 4 more times, it's positive 800, and we've expended 450,000. So we earned 800, spent 450,000. We still have a positive balance.
Nice when the math works
return.
out that way.
Yeah, I like it.
Finance
Yeah.
director.
When it works,
That's a good lubricant.
So, this is, for the first quarter, we're looking good. But again, yeah, we'll do the snapshot reviews and then.
Yeah, no, fabulous job as far as I'm concerned.
Thanks.
No, great team. Great team. Mayor?
How many humans are participating, retirees are participating in this plan? Is there any oversight as we're not adding new people to it? We're adding more money, the interest is doing more than we're paying. At a certain point, we won't have enough people. We'll have a lot less people in this plan. Is someone watching
Yes,
the number of humans?
yes, we do that, when we do the actuarial, we do the census, data on that, and that's what, every 2 years, we do a census of who's on the plan or in the future retirees. There's still a handful of current employees that do get some retiree help, and majority still get retiree help, but they get that minimum amount, right? And that gets calculated. We're at 3.1. I don't know if there's any.
There's no other exhibit that I was gonna utilize in the presentation.
I think, yeah, we got to the end. All it was at the end was the trust program. I'm just gonna go to it real quick. Here's the strategies. That was at the end, at the index. At the end of the report, which is included, there are different strategies. We're in the moderate. So it'd be that 11.3%, this one.
And that's through September 30th.
Yeah. Yeah, so this is in your packet, and these are the different strategies that we have, and how much percentage the strategic range. So the moderate 40, 60, fixed is 40 to 60, max is 0 to 20, and then I mentioned we're in that 50%. And then here's where early in the report, the 1 year, the index, we're at 9.65. So here it is. And these are the other 5 strategies, and we're in that middle moderate index. And then how Andrea mentioned, the next one up would be the balance. And then the highest, more risky one would be the capital appreciation strategy.
Andrew, in measuring your own performance, if you went to 55% equity, 35 fixed income, would the benchmark go 55-35, or would you stay at 50-50?
Oh, so if we're talking the moderate strategy
Yeah,
and we move to 55, the
Yeah.
benchmark would still stay at 50-50.
good.
And so then the way to, and we're really in just a bunch of index funds, so the
Yeah.
way that we would either add value or detract value, 9 times out of 10 is the asset allocation. It's not like we come up with a better index fund that's better than the index.
So this is all included in the packet. Yeah, we wanted to bring the team out again just to kind of start on the quarter review. And you can see, as of the September 30th, 25 positive quarter, and we'll continue to review that in the quarter ending, the second quarter, which ended 12/31/25. We'll do an update in a couple of months on it. Yeah, so we'll bring it to see where we're at, and then answer the questions, some of the questions about the investment expense, the flow of funds, how it's working. We have great partners with PARS as the administrator overseeing, and then Andrew and his team handling the investment. And then Andrew and I will touch base on some of these questions, and then we'll bring it back up, answer it. Hopefully when we see the second quarter, and hopefully it's another positive 200,000.
You gave me my marching orders.
Is it possible to have too much money in this? I mean, no such thing as too much money, but so. But we can't really move it anywhere else, right? It has to stay in here.
Yeah, and eventually, if,
Substitute money, right?
Yeah,
I was gonna say, eventually, as one of your questions was, we're starting to have less active employees. If at the end of the life of your plan, your retiree healthcare plan, you're done, there's no more employees, nothing left in there, any residual, any additional money in the trust goes back to your account.
It goes to general fund. We don't have to we're just it's awesome that we're getting so much more interest in what we're paying. So it's good that we're building, but at some point it might get too big.
So
And
maybe
And that's where you're not
35,
contributing.
40 years or so, it
Yeah.
might get to that point, but if the town is still a town and PERS is still PERS, we're still
The
gonna
town
have
is still a
active
town.
employees
mhm.
that get the PEMCA minimum. And if the fund is way overfunded at that point, how does that work? So the fund's got 2 million, or fund still has 8 million in there, but we only have PEMCA minimum staff moving forward. How do we
Yeah.
address that?
Well, that's why you're not contributing to the program anymore,
Right.
to try to stabilize that. And then also you have to think the investments, while I want to guarantee double digits or extra, Andrew won't let me, we will have some down years.
There's downturns.
Yeah.
And then if there's changes in the healthcare costs, right? The healthcare costs have been,
Right.
they keep going up. So there's gonna be compression, whether the investments do well or they don't do well, and then your costs keep going up. So right now, in the last several years, we've been fine, but on the liability side, the cost trend can go higher. And on your census, right, in the healthcare plans, have been going up, 10%, 13% a year. So when that happens, and if your investments, right now we're 113.
Actuarial.
Right, it is in the actuarial, and they review it, and then they kind of put in the demographic assumptions on the healthcare, the cost, the CPI. They also do mortality rates and all of that. So, the one thing is, if mortality rates improve, then your healthcare costs, your retired healthcare costs continues. So, there's that part of it.
At present, there's nothing that the town is paying that the fund can't pay. Is there any leakage? Maybe it's wrong choice of words.
No, we're also getting reimbursed from the amount the minimum PEMSA that we pay to CalPERS, we're getting reimbursed that as well through the the trust.
There's no other switch, no other volume to have the fund pay more and the town pay less.
Other than, yeah, just the retiree health, those components, yeah.
Agree?
Correct, yeah.
It's-
I mean, you could have those actual evaluations, but that's just like a small fraction of the.
Yeah.
Yeah.
I mean, that's something easy. I'm just thinking something easy.
Would the change to a charter town affect any of them?
Mm.
Okay, so that's,
Mm-hmm.
gotta ask.
Yeah.
Earthquake.
Exiting from CalPERS would
Exiting
Change.
from CalPERS.
change things, but that is an astronomical cost.
Yeah, yeah.
Surrounded
That's
by
true.
hills.
God,
The cost would go opposite. Yeah, we need more money.
I know that what, last year you put in $3 million is a discretionary payment to PERS,
ADP.
Mhm.
ADP. I mean, have you considered doing the PARS 115 trust instead of something like
I
that?
said, yeah, we have discussed that and that's still,
We've
An
actually
option.
established the trust, right?
correct. But it's not, as far as, we presented those options of putting it in the trust and let it build up or making the contribution here and then. And we've done that, just making it directly to CalPERS and let's see what it does instead of, right, just putting money aside into the trust for overtime. So I think that could be the next proposition is, okay, we've done the ADPs, instead of doing that, let's set aside a savings, right? Of
Yeah,
200,000 a year, 500,000 a year for the future for
That's more of a
pension.
council decision. Huh?
Mhm.
It might depend on how the new investment manager, CalPERS,
That's
performs.
right. Yeah, they just.
Maybe diversify your bets.
Manager and, yeah, and the plan has done well. They're staying at 6.8%.
Yeah.
They had a new portfolio approach that they're adding. So, yeah, I mean, there was only that 1 year where there was that negative. But yeah, so, I mean, yeah, but that is an option, is instead of doing the ADP, and we bring that up, but I think it was just to give the money to CalPERS, let's reduce our cost now, and see what that does. And it has, it's reduced our UIL component payments, it's reduced our normal cost rate.
The 115 wouldn't do either of those two, would they?
No, the 115 would it's just building what we've done with this trust, with the OPEB, just putting money aside for the future. I mean, in essence, what it is we're taking 500,000, whatever we put in there, and we're letting Andrew's team go and say, okay, let's earn whatever we can on this interest. So this 500,000 could be 5 million in 10 years, and then or longer, right? And then take that money, and then here you go. Instead of it being an operations expense 1 year, it's like, oh, now we have 6 million in here. Like this OPEB trust, it started in 2012, 2011. We didn't, at that time, I mean.
Well, we contributed
2012
to it.
We contributed to it, we did,
Significantly, yeah.
significantly, 5 million to it. So we almost doubled our investment, right, what's in the trust. So we put in 5 million and now it's 9.2 million. In a matter of what, 14 years. And with that, the liabilities have gone down on the OPEB, so that's helped create that positive net balance. But yeah, I mean, that can be an option.
Your knowledge of this and is amazing, and the comfort it brings to me is
Oh,
off the charts.
thank you. That's not to me,
The
it's
historical knowledge and your ability to fluidly move around these numbers is pretty impressive.
thank you. Well, just, you see it a lot, right? And
Yeah, don't discount yourself. Wow.
thank you, I appreciate it. But have a great team, we're great counterparts and stuff. So that assists us in just staying on top of it. And making sure that we're doing what we can and the council's directive, well, let's pay down our liabilities. And that's what we've been doing through the retiree health and through pensions. That's one of the things. Yeah, thank you. Appreciate it.
Any further questions or comments? Thanks, Jennifer and Andrew.
Thank you.
And thank you for coming personally.
Yeah,
Thank you.
we really appreciate it. We do. Being our, like I said, counterpart here, and, it adds more value. I know we can get the Zooms and stuff, but we appreciate it. Jennifer came up from LA. Andrew came down from San Francisco, so.
She might beat me home. I gotta go to East Bay.
Oh, sorry, that East Bay, yeah. But we really do appreciate all you do for us, and the partnerships. We'll continue presenting this every quarter and continue to work, refining what we can.
Thank you.
Thank you.
Thanks.
So much. And Happy New Year. 12 days into it, like you said, 13 days and there's more we have going on.
Take care. Bye-bye.
Okay. And the last topic is Robert's going to go over the asset liability management process at CalPERS.
Oh, yeah, but before that, there's item number 3.
Oh,
I apologize. I saw it as well. Item 3 was the brief review and update
Oh, yeah.
on.
I'm sorry.
No, you're fine. Brief review and update on the AI applications in the town financial software reporting and transparency metrics. Review and discuss AI applications tailored for municipal governments and financial reporting, dashboard reports and automations. This came up as at our November meeting. The committee, there was a question raised by members of the committee about the town considering the use of AI software, or if there's an existing software vendor to develop financial metrics dashboards for the town finances. As is the case with emerging AI, there are existing and developing AI applications for some of our software tools that are being custom made for our local government, and not just local government, at the state level and at the federal level. Again, there's focus on helping financial reporting, metric dashboards, and some more transparency and automated processing that are being developed for all our enterprise resource planning software. In the staff report, I mentioned it's ERP, so that a lot of these, that's what they call our financial softwares that we use. So other than Chat GPT is starting to become used within the AI applications, there's also Excel, Chat GPT, all these things that are being kind of created with OpenAI and also all these various software programs. So just, in the staff report, when they bring out what the town is doing, there's chatbot applications that are occurring, taking place. There's some websites. There's also chatbot applications that are going to be implemented in our software. So I just wanted to let you know and let the committee know that our current software, Springbrook software, handles our financial management, our payroll, our general ledger, budgeting, our accounts payable. It's all in one module, all in one software. The modules are integrated. So we've been with Springbrook software for 16 years. Over the years, they've innovated just like all these softwares around. They specialize in small local governments, and they have over 500 or so agencies, local agencies, and then additional, they have some county agencies. But over the years, they've innovated, and so now there is a cloud-based portion of that. And so we're anticipating to upgrade to that and migrate to the cloud-based. Right now, we're not cloud-based, we're our site-based application. So it's sitting in our servers. But this cloud-based application is more integrated with Microsoft, integrated with other software components that it's allowing us to have that opportunity for AI interaction. One of the things I mentioned, the staff report is within this new cloud base. They have an upgraded portion on the expenditure where there's an AI component, AI reader document reader, where invoices can be imported, they're read, they're populated in your system. You can verify the amounts. You can actually, and it's more, right now it's manual intensive. And with this AI reading, it's going to be less. It's more, it'll make the document processing easier to identify invoices being paid or not being paid on time, or just making sure the account numbers are done. And then you can interact with your vendors as well through the software. Like you can import an invoice, or you can take that and you can export, a report from there. To the vendors, so it's very interactive. So we're excited about that. That's one of the AI components that is being developed, not just in our software but other softwares to reduce the labor intensity on the
So does
document
it automatically
processing.
match?
Mhm.
And
Yeah, automatically matches and pays. You can update.
Not without verification.
Right. So it doesn't take away, it's not like you just throw it in there and it just, right, you have to approve it, you have to do the signing. I think those processes will still stay the same, but I think you're able to also interact with different departments, right? They can send invoices through the software, and it's more like an approval workflow, right? The workflow, here's this invoice we received. Do you approve it? Is this the right code? Put the code on there, and the document reads code numbers and it assigns it. And it's, again, George mentioned, you verify that everything's in there. So it takes the actual manual step of taking the invoice, reading it, reviewing it, coding it. It's more automated. So that'll help us. And just like AI, right? It's supposed to transform productivity, right? In the sense where it makes everything more, the labor intensive stuff that gets shortened, where you can focus on other stuff, the analysis part and all of that.
The
So
idea is to stay with who you have because it's got this historical information and they've got a history of updating themselves. And
Right.
so maybe there's another piece of software that's just a little bit better, but the conversion is just going to be crazy. So we're just going to stick with who we have.
yeah,
Because this is all very familiar stuff
Yeah.
to me. The area where I would encourage you, you mentioned chat as an example. We're all watching out for privacy issues because when you let stuff out into chat,
Right.
then the rest of the world learns from the town of Atherton also, theoretically.
right.
The area where I think it could be really interesting for you as a controller is if you take this document and the other 100 that you've done for the last whatever period you have and feed it into the engine.
Right.
That you could go back into it and all these questions that are coming up can be digested and answered for you through an inquiry.
Right.
And it'll be unique to the town's information.
Right.
So when you ask, okay, how many people are involved in there? How many people are involved? You do this while you're, watching Netflix. How many people are involved in and then out comes the answer.
Right.
So I think it's beyond the accounting.
No,
It's going to be a data lake of whatever you could with privacy introduce to that system and go, I want you to learn from all this. But it's still far away.
It's actually not. There's a hat that the mayor's got that says, I read the packet. It was provided by prophecy.com, which was at the last Free Managers Conference. Prophecy.com does exactly what you're talking about. It mines the Atherton only website for every single document that's on there, and then creates it for staff to be able to write staff reports, replicate information, and answer questions.
Boy, you gotta watch privacy.
Right.
That stuff's gotta be rock solid.
Yeah,
You can't introduce documents to it that have.
And I think that's the thing is, some of these softwares are working with open AI, right? And as you mentioned, right, you can get they're showing OpenAI what they do with their processes, right? They're reading it. So what can happen from that? Like whether information gets, they get information on processes or what is it? What's the word I'm looking for?
The example we have now is we'll take information, we'll put it into one called Claude. Claude then could actually have a particular software can actually have your name and your salary and your whatever, right? A snapshot in time. It then, this is theoretic, removes all that information, right? Puts it out to the general, like ChatGPT to get its question answered, pulls it back in and then adds your name back onto it again. I still don't have confidence that that's what's occurring,
Right.
that can achieve
No,
some of the stuff that you want.
yes.
It's coming.
It's coming and there's some, like, some of the transparency stuff, like OpenGov is creating that. They have AI tools within there where you can create on procurement, where you can, take a document and throw it in the AI component and then it creates a whole procurement.
Yeah, it's gonna affect your staffing too.
Yeah,
So the difference between open government, open gov, and the Springbok Cirrus,
mhm.
they're two different.
They're two different things. OpenGov is the transparency tool that we use to we can show our actual or year to date and our budget. Springbrook is our actual financial software that we keep all our financial data, our financial management. The good thing with OpenGov is OpenGov reads Springbrook and it takes our information every night and it feeds it into OpenGov, where you can do the transparency portal where you can create graphs and charts and stuff. So we use it in tandem.
The transparency portal, is that just the town's website?
It's OpenGov, but it's on the town's website,
Yeah.
correct? But a lot of these agencies are working with each other, like OpenGov's working with OpenAI, right? And they're creating all these things, but it's like, where's the control of some company can decide, oh, this is how they do it, and we can do it on our own, right? And they create a product that they beat the other person out on the product, right? Because they created it.
There's overlap for sure.
Right, overlap. And case in point,
It's a race to market.
OpenGov at the time was just a transparency portal where we would take and upload our data in there and it would spit out the information. Well, in its infancy, OpenGov was partnered with Springbrook on reading the data and stuff and all of that. And so it worked. Well, what does OpenGov have now today? They have a financial software tool that does what Springbrook does. So all this partnering in there, it's great, but at what cost, right? And so as this AI component kind of develops, a lot of it is because of the ChatGPT, they've been working with these softwares, and this George just brought it up. So this stuff pulls in from our financial software. It's a read only to our financial software. All it is take the information and we map it. But OpenGov has now not just this, but it's a financial software. They have permitting and licensing, all these things where they worked with other software developers. Like, how does this work? How does this work? And now they're competition for them. But with Springbrook also has, I mentioned it, there's a Tableau, which is similar to this, but it's straight from Springbrook. So, so there's OpenAI stuff where, see these filters and these views, you can create them, right? Well, now OpenAI can go in there and say, okay, I want to know the property taxes for the town for the last 10 years. And it'll create it, right? So the innovation's there. And it's happening quick, but at the same time, it's like where governments are still having to create policies about the use of OpenAI because it's just exploding. It's so fast. And another thing they were talking about is OpenAI and these ChatGPT applications create hallucinations, right? Where makes it seem like this is real, but it's not, you know, because you're reading, it's just taking data and it's just a supercomputer. And it could create hallucinations, so that's where the human element comes in.
Well, it's good that you're open to the idea, and it's good that you're trying to control the idea.
Yes.
The two gotta coexist.
So you're planning on converting to the cloud-based?
Yes. with
And is
Springbok.
that with the $75,000?
Mhm,
And
yes.
then what's the $10,000?
Oh, so the 10,000 is we allocate that amount every year from the finance department
Okay,
to our equipment replacement fund. So
Okay.
we've done that for the last several years. So the amount that we've contributed
that's
to
just
it,
an annual.
right, an annual allocation. So what we've contributed over the years pays for that 75,000 migration. So we.
So you don't spend that 10,000 every year?
No, we don't. We just allocate it to our
Spend
equipment.
it, so
Correct.
you've
We've been
accumulated,
building it. Mhm.
and so there's $75,000 tagged. And then
Available.
does that include the training also?
Yes, this includes the training. It could be plus or minus, but it includes having the on-site training, and that's what I'm requiring, is not to, I've been through some migrations into new software, and the training is like 3 days, and then all of a sudden you're on your own. No, this is gonna be, walk us through everything. And I'm glad that you mentioned it, Steve, because changing from one software to another it's a nightmare. But Springbok
You
is.
should lose your historical data no matter
Yeah.
what they tell you.
Well,
Correct.
not if you, but you can also do it to keep the store.
Oh, good luck.
Well, I've done it.
Yeah, I
It's
know,
hard.
but with,
I mean,
Yeah.
it's
all
hard.
these buckets and multiple
It's hard,
codes
but
and
It's hard.
categories.
But is there gonna be much of a conversion when you go to the cloud-based application?
There will be conversion as far as the interface, the way it looks, like, where you go, in processing things. Right now, it's more of a,
Is it
You know,
using the same database?
yes, it's using the
It's
same
using
data
the same
space,
No, we're
but
not cloud-based now.
no.
No,
Yeah.
so there is gonna have to be a conversion to the.
But
cloud.
within the same software provider.
Yes, within
So
Springbok.
that's okay.
Yeah, and what the good thing about this, the cloud-based, like any upgrades or any like.
Of course,
like,
yeah.
It's
Yeah,
automatic,
welcome to the year
right, they'll
2020,
do
right.
it and stuff,
Oh,
but,
yeah.
and it's more secure, right?
Totally.
And so, it's just it's a different look on the interface, and
Yeah.
what's good is they understand that, so you can toggle between what you're working in
Yeah.
and the new interface.
For a
So
while.
I have staff that is used to doing it this way, and I can find here in this module, so you can go back and forth, and you're not like, it's not like, okay, once you're in this new one, you're
You're
just
gone.
working in this new one, so
Yeah.
you can pivot. And so, which is, I think is beneficial. One, the information is already there. Two, it also helps with the integration. Another thing too, we want to do, there's express bill pay. So people can pay online through credit cards. or-
Is that included in the budget?
Mhm.
So,
Yes.
and the AI portions of
And
it?
the AI portion, correct,
Mm.
yeah. So that's another added benefit is everything is integrated. So on the payments, right, taking payments, it'll be
Mhm.
through the express bill pay is the payment application for Springbok. So
Sweet.
it
Yeah,
you
records
pay and
itself.
it talks to your GL, it talks to your cash receipts, and everything's integrated. Right now, when we take credit card payments, we take it, but it's manual entry,
Mm.
right? This is seamless, right? So that it's much needed, and we need to move more to that direction. And stuff, so.
And the budget also includes the AI modules? Are there
Yes.
any other?
Or anything
besides
that,
Express Pay?
for now, yeah, unless, and then if, I think if there's anything that gets created, there may be like, that's not already in there, they may say, okay, like, yeah, correct, an add-on.
Yeah.
So when we do this, we'll verify, okay, what is the future of this version of the cloud? Is there anything that's additional? Yes, if it is, okay, what are the add-ons? And then going forward, it's just upgrades, right? Whatever, it's refresh upgrades for, if they find a bug on something, right? It automatically will update. The other thing is, what was the other, was mentioned on the, not the upgrades, but
Does it change the licensing fees?
The license fee should be about half of that a year, which means the license.
So it will go down.
Yeah, the license fee would be about 34,000, which includes customer service, customer support.
So that's everything.
Mhm,
That's all.
everything, and we already pay that right now. We pay that.
So so in the budget,
Mhm.
our costs will go down,
No, this is a one-time cost.
right? That's.
And then our maintenance cost is already in the budget, which is our customer support, which is for all the modules is about 34,000 a year.
And that'll stay the same.
That'll stay the same.
But the licensing, you said the licensing.
That is the licensing, that 34,000.
Because at first I thought I heard you say it would go down, but it'll stay the same.
Yes, it was
It'll
stay.
it'll stay the same.
Sorry about that, yeah. This, I meant the one time would go down,
Oh,
75,000
yeah.
one time.
And then the open gov work,
Mhm.
how much does that cost, or is that?
That's about 32,000
And that's not included in the 75.
correct. And that's already budgeted in on our annual budget, that part
Okay.
for OpenGov. The same thing for the Springbrook maintenance, that's already budgeted in our operation budget. And another thing with our Springbrook is we have customizations in there that are specific to our agency, specifically customizations for the state, our pension, right? It's custom created portion in our software that we can create reports, run reports, because we have to download every 2 weeks, we send the pension data to CalPERS. And so that's a customization, like there's a customization for the state of Oregon, right? They have to customize their software for what is required there. So we have some customizations too in our software, and that's what they're aware of it. So that I think staying with them, upgrading with them, it's the best thing. And then the customizations also are included.
Are included.
That's-
And do you know, like, initial uses, like, do you have a list of initial uses of AI?
Other than right now, it's the bills. The bills, I think there's gonna be an AI component on the reporting, on the Tableau, where you can say, tell me the last, for property taxes, and you enter the account code, and it should bring everything up. But right now, I think the biggest ones for us is the AP component, the accounts payable, and then the express bill pay, to take on, pay online, pay via credit card.
And when do you want to do it?
This, I'm working with Springbrook, and hopefully not in the next 2 months or so, probably towards the end, it's summertime. Right, because my hiccup is don't want to do it when you're in the middle of budgeting.
Right, yeah.
Because then
Middle
there's
closing the year, yeah.
middle of closing the fiscal year, so, yeah, so, and it's just also making sure that it aligns with their timeline with their consultants, right? Because they're gonna have to send them here, the time for them to do this conversion, switch over to the cloud, and then I think the cloud, and then also to organize the training, right? And the training will be, I'm assuming 2 weeks, but each module will be 2 days, 2.5 days.
Do they also have to reintegrate it with OpenGov?
I don't think so. I think it'll just be because OpenGov is an SQL reader. I think there's something like that it just reads. It's just making sure. I'll update, making sure I'll verify on the reader. But we didn't only with Springbrook when we worked with OpenGov, we just had to contact Springbrook to have them the ability to tag in and read it. But other than that, it shouldn't be so much.
If the database isn't changing.
Correct. The database isn't changing, it shouldn't be a big change, but thank you. Those are one of the things we'll ask.
Things are never as easy as you
No,
think they're
yeah,
gonna be.
I hear you. Yeah, you're right.
Does it increase your prospect pool for employees because now you could have more work at home, or is that something we don't do?
The work from home is something we don't do. I think it's part of it.
Because of a management be here, do work kind of.
Not so much that, but I think more we're a public servant, so how can we serve the public when we're at home? More that approach, but we do, I mean, some of the directors work from home. But I think on the
So that software in particular won't contribute to that. You couldn't have an AP person that's wants to work Friday from home and
you can, I mean,
away they go.
the software will be available to log in, right?
Right.
You can access it anywhere, like a
Mhm.
a
Or
portal.
VPN.
Yeah, VPN portal. But I think it'll help, I guess, streamline,
Mhm.
not just the workflow, but also, the analysis to reporting, the cash module, the bank rec module. A lot of it will be, more, I think, streamlined and easier, all Windows-based already, but I think more now with these applications, for data.
Auditors will like it.
Yeah, they will. Yeah, give them a log. Here you go, log in. You can
Mhm.
pull it yourself, pull up the information. But yeah. But that was my update on that. Just to let you know where we're at. And then the AI component, I'm still like evaluating it, like with the OpenGov, they're working with ChatGPT. I'm creating the components within their software. So, and then trying to see what other agencies are dealing with and making sure that policies are set up too. So it's not, we run them up, right? That was for item 3. Any other questions on that one?
Thank you.
Yeah, and then on the ALM, I just want to kind of highlight real quick, I attended the webinar back in early December and I included in your packet, the ALM review. And again, this is a review that's every 4 years that CalPERS is doing. At page 9 of the, packet is the kind of where the main meat of it is the board adopted the total portfolio approach. And this was, I kind of briefly discussed about it at our last meeting. They're doing the 75-25 equity bonds reference portfolio, and then they're allowing that active risk limit of 400 basis points, so 4% for within that portfolio risk adjustment. And I think that's, Tom, as you mentioned, hopefully the new investment person has that extra tool so the plans can move within that 400 basis point for the risk limit on the actual portfolio. And then there's no change to the current discount rate. 6.8 is going to be the same. And then just, on the adopting the portfolio approach, there's no changes to the board's authority. The ALM process is a 4-year cycle, midpoint review, to verify that the capital market assumptions are being met, if the expected returns are being met, if there's any changes that need to be made. Again, they review the whole actuarials on the assumptions. Again, there's a reference portfolio, there's the active risk limit, and this replaces that adopted target strategic asset allocation and ranges that they were using before. And again, the board will continue to review this total portfolio fund risk. And then that's pretty much it. Just kind of, it evolves into, better outcomes. They kind of put like a matrix of metrics of improved internal governance, reference portfolios on page 11, simplicity, better transparency, greater accountability, investment decisions for the whole. And then the rest of the report, it kind of goes through what the process will be. But on page 19 and 20, 18 through 20 kind of discuss the actual assumptions. The economic assumptions, obviously, the long-term investment return that they're looking at. The discount rate is staying unchanged at 6.8. They're verifying inflation. Inflation has gone up the last previous years, so they're factoring that in there. Other non-economic assumptions they're factoring in on the going forward is pay increases, longevity, retirement, termination, disability. all these are getting factored in these new, assumptions for, the ALM process. And then demographic assumptions, shows on page 20, starts on page 20, on what's changing. Retirement rates are staying the same, that some are increasing while some will also decrease. Mortality rates is something that they looked at. There's a slight reduction in the mortality rates, projected mortality rates, slight reduction. There is a minimum changes, there's termination rates, minimum changes have been adopted. I think the biggest one is the discount rate. Because if the discount rate changed from 6.8, the whole asset allocation would change. Your investment opportunity would change. So they're keeping it the same. I don't think it's going to change until another 4 years. We still have the funding risk mitigation policy that takes effect. But last year, April of 24, it's no longer automatic. It was automatic. Now, if it gets triggered, and this is if the investment rate of returns is 2% higher than the actual discount rate, then that it creates a funding risk mitigation policy where it reduces the rate of return by 0.05%. That's not automatic. If it happens, they bring it to the board. Again, that happened this year. We had a positive 11% increase in the investment return. And so it created an investment risk mitigation policy. The board presented the board not to recommend a reduction. So again, discount rate would be at 6.8%. I think eventually over time, it could go from 6.8 to 6.5. Most investment portfolios are at that 6.5%. Question. Yeah.
Who's on the board? Are you on the board?
Helpers board?
Yeah,
No.
who are these people?
I wish.
State appointees.
Appointed
State
by-
appointed, yeah. They're appointed by the
Governor?
state.
They elected, or I would hope not,
No,
as
they're
an
not.
elected.
There's, I think 2 elected members, but that they're elected by retirees or by CalPERS members. Elect, I think 1 or 2 members on the board, but majority of them are state.
Very smart, they're
Yes, yes.
very smart.
These are them.
There you go.
I know there is at least one union representative. if
Correct.
not more.
Yes, union representatives.
They look intelligent, right?
Yeah.
I've watched the thing where, you know, they were in attendance and they were asking questions and they all seem to be on top of things.
No,
And
they're,
seem to be competent people.
Robert, I don't think that was the biggest change. For me, the biggest change was the post-retirement mortality for men. Slight reduction in the projected mortality rate. I think that's great.
Is that assuming everyone's gonna live longer? Is that a reduction of mortality rate is
Yeah.
longer life?
Yeah.
Yeah,
It's good.
Plan accordingly.
Yeah, exactly. Oh, and then I just want to point
Everyone
out, yeah, live long and
Men, not
prosper.
women.
No, it's both, it said, was both,
This one, we don't have any choice.
yeah. In the base.
Thanks for bringing it
and-
up, George. I was gonna bring it
okay.
up. But page 25 of the report, it kind of shows the funded ratio. So last year, 24, you can see the funded ratio was 74.4%. And current assumptions are in blue, proposed assumptions are in green. So in 25, the funding ratio increased to 79% on the current assumption, and then proposed assumptions it reduced to 5.4%.
so this is a key thing to me, that 6/30/25 hasn't happened in terms of the allocations to UAL. So when they say it's gonna go down 4.4%, I think for sure what they're saying is there's going to be a UAL layer added for assumption changes. And I think on the next page, they imply at least that depending on your plan, things could be different. But if that was just the average, if we were at the average, I've calculated it's gonna be an added layer of 300 to 350,000 for all plans, total after the plans.
On the UAL?
Yeah, it's gonna add to that. It's gonna be,
So we're gonna have to contribute.
An
Yeah.
amortized.
Amortized, yeah,
yeah.
yeah,
But also we know for 6/30/25, there's a huge investment gain. It's
Correct.
gonna go the other way.
Yes.
So, in net, I would think we're gonna end up better than we are right now.
correct. And then you got to factor into we just made the 3 million ADP.
Yeah,
Um,
and I didn't calculate that
yeah.
in when I came up with this 300,000.
Yeah, so that's gonna be benefit.
Yeah,
We made it after the April deadline, so it didn't, it's not factored into the actuarial report we received, but it'll be in the next one. At the end of 25. And then, yeah, it just mentions that, you know, there's new assumptions that'll be used for the June 30, 25 actuarial evaluations. These, the changes will update our public agencies. They will affect our contribution rates in fiscal year 27-28. So, 2 fiscal years from now, these changes in the ALM will take effect. And then it'll be, the ALM will be effective July 1st, 2020. I mean, 26, sorry.
Yeah.
They're voting right now, and then in July 1st, thank you, I'm still in 25. Only 13 days in New Year's, but yeah, so July 1st of 26, these new ALM rates and assumption changes will take place. And that's why it won't affect our rates until the 27-28 year. That's all I have.
okay, shall we talk about agendas coming up?
Sure.
I have one question, and that is, the audited financials.
Yeah, I'm working on those.
We have that in the next meeting.
Yes, we will have it for the next meeting in March. And then, the other one I wanted to bring out was since we're talking about CalPERS, is working on bringing, Julian and, the investment team out. And they couldn't come out this month, but, I'm hoping that maybe they can come out in March as well. Yeah. So,
Anybody else have agenda items? So are we ready to adjourn?
Let's do it.
Yeah, will we adjourn?
Oh.
Okay.